Hello, everyone. Welcome back to another episode of Creating Wealth with our amazing teacher, Robert Allen, our mentor, the one and only. How are you doing?
Oh, thank you, Marjorie. Awesome.
And we're super excited for today because we have been getting questions about, oh, wow, we get it. Real estate is the way to go. How do we do it, though? The first question that we got is what are some of the numbers that you look at when you are buying your first property?
Well, beginners usually start at the lower end of the scale, and you're going to start with probably a single family home, condominium, maybe townhome, something in the lower end of the scale. You can scale up. You can go from there to 10 units, 50 units, 100 units, 1,000 units. You can go into commercial real estate where you own office buildings and storage space and things of that nature. But the beginners are usually going to start with what they know. And since you live in a house or an apartment or a townhome or a mobile home, very few people live in parks. So you're going to start with what you know. And that's why what real estate is such a great beginning investment, because people, they wake up in a house, they go, oh, yeah, I kind of familiar with this. I can see myself renting this. I think I can see myself renting this out to somebody else. Yeah, so that's where you start. That's where I started. I started with a duplex, two units in this one property that was converted from a single family home with a basement to a unit, one unit up and one unit down. So you start there, and here's what more people make mistake. Let's go to the last time where real estate prices dropped. And it's the only time it has ever happened in the history of the United States, basically, for a substantial drop, was 2008 to 2011. Prices dropped. Why? Because supply and demand. Too much demand forces prices up, forces beginning investors to get loans they couldn't qualify for because they were giving mortgages out to anybody who could fog up a mirror when it was held under their nose. So therefore, millions of unqualified people jumped into the real estate market to buy properties they had no business buying, frankly. And therefore, when they couldn't make their first mortgage payment or two or three, they dumped those properties back on the market. Supply ballooned up. Supply increased dramatically. When supply exceeds demand, what happens to prices? Prices will always fall. That's just a law of economics. So why now? As a beginner, if you're a beginner, you're looking for a smaller property that you can buy. This is where the greatest amount of demand is. That's a bad thing. That means everyone and their dog is looking for the least expensive property because it has the highest probability of increasing in value. And when you get into high price properties and the 1 million, 5 million, 10 million, the prices are not increasing at the same rate. But why would you want to go to the place where there's the most amount of demand? Well, what's happening to interest rates? As we speak, interest rates are going up on a monthly basis. Mm-hmm. The mortgages are going up. When they go up, it immediately wipes out. It goes up a point because it wipes out another 10 million people who could have afforded that property. Therefore, it took that demand off the market. It goes up another point, and it will in the next 2 years. The rates will continue to go up. Why? Because inflation has gone out of control. It's crazy. Therefore, you want to be in real estate because that's the thing that affects the inflation the most. The prices of everything that goes into building a house, the lumber, the carpet, everything else is going up in price. So therefore, your property in real estate goes up. So you bought your house for, let's say, $400,000, and now it costs $450,000 to build that exact same house. That means your home is going to go up in value automatically because of inflation. But as inflation goes up, interest rates are going to go up to try to cool that off. So it goes up another percent, which is another 10, 20 million people can't afford. So it's going to take that demand off the marketplace. So you have to be looking, and this is the rule, and you'll hear me say this. Maybe if you're watching all the videos on YouTube, you're going to hear me say this at least 10 times. Don't wait to buy real estate. Buy real estate and wait. Meaning, I know it's hot marketplace, but here's the secret you need to know. 1% of any market, anywhere in the world, is owned by people who don't want it. They don't want that real estate. Maybe they inherited it. Maybe they're going through a divorce. Maybe they're being transferred across the country. Maybe there's too much deferred maintenance and they can't afford to fix it up. Maybe it's a small apartment building and they just a friend of theirs died and left them in the will, and now they own this apartment building and they have no clue what to do with it, and they don't know how to sell it, and they're totally ignorant about the process. 1%, which means that in your city, how many properties are available for sale? Well, let's suppose that in your city there are 5,000 properties available for sale right now. That's probably low, frankly. That means that 1% of those properties are owned by people who don't want those properties right now. They don't want them. They're actually anxious to get rid of them. Maybe they got a mortgage payment coming due. Maybe their credit rating is really important to them, and they know that in 30 days from now, it's going to destroy their credit. What if you showed up where they had procrastinated themselves until 30 days left? And now even putting on the market, even a hot market might be too long. Therefore, that you show up to solve that problem for them. And that 1% represents, if there are 5,000 properties in your neighborhood, that's 50. Now, it doesn't seem like that many properties, 1%, 50. But how many do you need? You need one. And most people are buying as if they are speculators. They're buying anything that lists. They're going to pay for it. They're not even going to ask for the price. You have to dig deeper. The hotter the market, the deeper you have to dig, and the wider you have to go. So as a beginner, I've always said you should only invest within a 25-mile radius of your own home. So if you rent something out and it has a problem with the tenant, at least you can just drive over and look at it. If you're buying it in another state, you're going to have to fly to look at it. Therefore, your costs go up. Therefore, you become what I call a highly motivated seller or a don't wanter. So that's out-of-state owners is a perfect example of people who you should be researching. Talk about going deep. Mm-hmm. Go to your county courthouse. Find out where are the tax notices being sent. All the out-of-state owners, all of them. Some of them own properties that they left and rented out, and now they've had a problem with the tenant, and they made a decision. The wife has said to them, it was your deal. Real estate was for you. And look what it's caused us. Get us out of this thing now. I never want to hear the word real estate again. The husband or the wife is probably going to say that. And because they had a problem. And so you show up at the exact moment of that argument. As I showed up at the exact moment of an argument with a 13-unit apartment owner. These two owners fighting with each other because for years they hated each other, but finally they just came to a head on that day. Oh, wow. It was a good market. It was a great market. There was a good property, great location. And I had my bird dog out looking for deals for me. And he called me and said, Robert, you got to get over here right now. These guys are having an argument. I show up. They're arguing. I make an offer immediately. What price do they want? I said, I'll pay you what you want. They tell me a price and I know it's low. Why? How do I know that? Because it's in my buying farm. That means it's a target territory that I've decided within a 1 or 2 mile radius or mile square. Within that, there are a couple thousand properties. And therefore, I just notice the property values that are going up or down in that local area. And therefore, I knew that the price per unit they were asking was below the market. And I just gave them exactly what they wanted. And I said, great. When should we close? 7 weeks? No problem. Here's a $500 check to kind of hold us. The money's coming really quickly anyway. So I give them a $500 check, hoping they wouldn't cash it. And they took it right there on the spot. Oh, wow. Now, why did that happen? Because I was looking. I actually had hired a college student. I went to my MBA class years after I graduated, and I went through in the summertime when all the students were looking for summertime jobs. And I said, I've got a summertime job for somebody. I'm not going to pay you any money. Zero. You're going to be my apprentice. But if we make profit on the properties you find for me, I'll give you 20% of the profit. Oh, wow. I'll use the money. It'll be my money, my credit, my cash flow, everything, all my finances. I do the buying. You just do the looking. And therefore his name is Rex that summer. Rex earned more money than anybody else working for anybody else that summer without me paying a single dime in salary. I didn't have to pay it up front. It only was paid if he produced.
That's cool.
And so what I'm trying to say, you need to go deeper in ways to find deals that ordinary people won't do. And the reason they won't do those deals is because they don't know how to do them, or they're afraid to do them, or they've never heard what I just taught you about how to do it. You need to go deeper. And you're going to find that 1% of the properties you'll stumble into because you're out there falling. But if you're waiting for the market to change, when's that going to be? By the time you wait to save enough money for a down payment, to save enough to be able to fix your credit, to save enough to get a little more assets on your balance sheet, to have a better job with more income stream coming in so you look better to the banker, that's going to take you 1, 2, 3, 4, 5 years. And while you're waiting to improve yourself, the market is going nuts. So by the time you finally can qualify for a property you thought you could qualify, 3 or 4 years ago, now the properties have gone up so much you can't qualify then in the future. So what you need to do is to get in the market now. You say, but I don't have enough money to qualify. Well, here's the statement you're going to hear me say over and over again. If you don't have it, somebody does. And you can encourage them to share their resources with you. Or as Tony Robbins would say, if you don't have the resources, you must be resourceful. So resourceful means to resource things. So your credit rating sucks, as in my case, I bought a 12-unit apartment building. I got half ownership in this building. When I applied none of my financial strength, I'd figured out how to buy it with nothing down, but it required a brand new mortgage, which I couldn't qualify for. It was too big of a building. It required too much of a down payment. But my rich friend who I'd helped buy some property owed me a favor. And I said, Stan, I need you to qualify for this loan for me. And for that, you get in with nothing, no down payment, because I got the nothing down techniques working for me. I just need a bank loan and I can't qualify. So I was resourceful. Therefore, I brought the resources I didn't need, and I had to give up half ownership. Yes, it was. But that one building ended up making me about $500,000 for half ownership. That was a good deal, 5, 6, 8 years later. So if you're using the excuse that you don't have the money, then you're searching for the wrong thing. Right now, there is a plethora of money. Money is everywhere. Money is chasing after few pieces of real estate. That's why prices are going up. Supply and demand. Too much demand, not enough supply, prices will go up. So you go run an ad in the newspaper, just say, this is the kind of property that I find, and show them the kind of deals that you're looking for. People with money will respond.
Or even easier now. I mean, you can actually do it on social media and it's for free.
Totally, exactly. So you you say, I'm being mentored. Watch my videos. I'm being mentored by Robert Allen. He's showing me how to find deals. This is the kind of deal I'm looking for. I'm looking for a deal that can be purchased 10 to 20% below the market. It's going to require cash. I'm going to be your bird dog. I'll find the deals. I have the deals. I'm just looking for the money to put it together. You can bring your attorney, whoever advisor you want to be in, to make sure you're not being taken advantage of, that I'm not doing something illegal, immoral, unethical. Bring your advisors in. But when I show you the deal that I found for you, you're going to go, wow, can you get me some more of these? And now you become a bird dog. You go look. You look for deals. And guess how you look? You look as if the money is already in your bank. How would you act if there was $10 million in your bank account right now?
That definitely changes the perspective, because I feel like most people, they only think on what they currently have, which limits them from what they can truly achieve, what they can truly buy as a property. So thank you so much for sharing that. And now that we're speaking about buying our first property, what are some of the things that you look at on the property itself? What are some of the red flags that you try to avoid when you look at a property?
5 questions.
Mm-hmm.
They're the 5 basic questions, but you need to score every part of them. Most people won't ask these 5 questions. Therefore, they get into trouble. Question number one, location is the most important. Can you buy in a bad location? Yes. But as a beginner, no. Don't do that. Just don't do it. It's too dangerous for a beginner. So you score it on a scale of 1 to 3, 1 meaning bad location, 2 meaning okay, 3 meaning excellent. Just so you do it on the phone, you do it without seeing the property. You look at pictures, yes, but in terms of you going and looking and evaluating and kicking the tires of the property, no, don't go look at it. You just got to score well before you look. So I'm going to evaluate these 5 areas: location, condition. What condition is it? What kind of money is it going to take to bring it up to speed? Financing. What kind of financing is it going to take? A brand new bank loan? Well, that's going to be harder. That means I'll probably score it a 1 if it requires a bank loan. If the seller's willing to carry some financing, some of it, I'll give it a 2. If the seller's willing to carry all the financing, that's a 3. In other words, I'm looking for flexibility in the financing. Price. Now, each of these areas have a score from 1 to 3. So if the price is on the market or above, that's a 1. That's not good. If it's a little bit below, that's a 2. If it's 10, 20% below, that's a 3. Now, it could be below the market currently because it might be a residential property, and therefore homes are selling for that price. But if you could improve the income from that property by putting in assisted living, like making a home available for people who are struggling with autism. There are all kinds of ways, government programs that let you retrofit a house so that rather than renting it out for $2,000 a month, you can rent it out for $10,000 a month. Oh, wow. Yeah. So by increasing its value, by doing some tricky things like that, you dramatically increase its ultimate value, because now it's a business and not a piece of real estate, not a single family home. It's a business, which now you will sell that business based upon its income, not on how much it costs to replace it. So what I'm saying is you can pay above market price if you have in your future ways to increase its value dramatically by increasing its revenue, its rent, such as rezoning it from residential to commercial. That will immediately dramatically increase its value and its income. And what if you knew that you could get it rezoned and the seller really wasn't aware of it, or this just didn't really even care? Their house, they've lived in it for 30 years. They thought it was worth this because the neighbor sold it for that. You pay their price. So these 5 areas: location, condition, financing, a price, and then finally, what is the motivating reason that forces the seller to sell? And this is the thing that most people don't ask. Why are you selling this? What forces you to sell it? Are you just trying to put it on the market, see how much you can get? That's a bad reason. That's number 1. Yeah. I'm moving to another state. My wife left me. I've got cancer. I need to sell this. Whatever. I've just fixed it up and I've got a profit in it and I'm trying to capture the profit. There are lots of positive reasons and negative reasons why people need to sell. So you ask those 5 questions and give it a score of 1 to 5 on all 5. If it scores 10 or less, don't buy it. Mm-hmm. If it scores 11 or more, write an offer. And if the seller says no, put that offer in your file folder, because 1 in 10 of those offers you write that are rejected, somebody else beat you to it. Eventually that person may not be able to complete it. And guess who they're going to come back to? The person who lost the bid, the number 2. And I've heard story after story after story. So you never give up. You just never do. You plant the seeds. You got to plant seeds to get a crop. So if you're not writing offers, you're not planting seeds. If you're not writing offers because you're afraid, your failure is giving you 0 results. That's 100% failure. So get out there and at least write the offer. You have a clause in there that protects you, that you have to inspect the property before you close on it. So you now can write an offer risk-free. You write the offer, it's accepted. You go in and look at it. You go, I don't like it. You just say, I'm sorry, I don't want it. You give it back. So there's no risk. Hello? Plant seeds.
Why are you waiting?
Exactly.
And like it's super interesting how you mentioned that question of finding the motivation of the seller. Because to be honest, I actually applied it myself when I bought my first property. And I remember talking to the sellers and they said, well, the thing is that COVID is happening here in Utah and there's no COVID in Arizona yet. So we want to go as fast as possible. And I mean, I'm not the CDC, so who am I to correct them? But
Yeah, exactly.
but it was interesting how by asking the right questions, you can know which property is a good deal and which one isn't.
Yes.
And in fact, I was actually number 2 on the bids when writing the offers, but the first person wasn't able to complete the financing part of things. So it's always really good to take that leap of faith and go for that deal because there's really good deals. People are buying all the time. We just have to do the work until you find them.
Yeah, there are properties that are waiting to come on the market right now.
Mhm.
They're having a problem. They had it this week. They just learned about it a week ago. They didn't want to sell, and now a week has come and a disaster has happened. And just like you, COVID happens. I need to move immediately.
Mhm.
So if you're not out in the marketplace looking for deals like that, you're not going to stumble into them.
So yep. So I guess the lesson for this podcast is go out there and
Do what Marjorie did.
go and do. I wish. Go and do like your first investment. Don't feel afraid of it. Just go for it. It's a little leap of faith, but that little leap of faith is gonna generate maximum profits along the way.
Exactly.
Thank you so much, Robert. And amazing questions for us to ask now on our next property. Thank you so much. And thank you to our audience for tuning into this podcast. See you on the next one.